Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert George Roberts. Now, George is the founder of Roberts Capital Enterprises, a multifamily investment group that focuses on value add opportunities. Now, in addition to owning over 550 units as an active multifamily investor, he is also an avid passive investor and holds investments in with a number of other sponsors. Now, his passive investments include over 600 multifamily units, car washes, early stage companies, as well as triple net leased real estate. Now, before devoting himself to commercial real estate full time, George worked as an award winning data scientist and bioscientist with nearly 800 citations in the fields of genomics, microbiology, and physiology. Now, lastly, George is also the host of the popular YouTube channel, The Data Scientist of Real Estate. He's also a published author as well as a podcast host, and we'll learn more about that here during our interview with George. And so, with that, guys, I'd like to welcome our guest for today's show, George Roberts. My friend, how are you today?
Fabulous, Kevin. Thank you so much for that introduction. Great to be here.
Yeah, excited to have you here. Excited to pull back the curtain and learn a little bit more about you. So let's start there. I gave that brief introduction. I know there's a little bit more to it. I'll pass it back to you, George. And if you would, for those that aren't familiar with you, your background, who you are, what you do, where you came from, fill in the blanks for us if you would.
Absolutely. I started my career in tech, ended up becoming a landlord during the depths of the Great Recession. Couldn't sell my house for much of anything, so we turned it into a rental unit when we bought our new family home for our growing family. And that was a great education in the value of cash flow. I'd always been a stock investor, but really had no idea of the power of real estate. So over the years, we kept that one rental unit, and at some point, the idea of expanding my investment horizons came about, and decided that I would rededicate myself to real estate, but this time to go and do real estate at scale. And I became a multifamily owner. Started out in Orlando and bought apartments all across the South. And from there, that's really where the passive income story began, because I also, as you mentioned, started investing with other sponsors. So it's just been an incredible education ever since I opened up my mind to the world beyond stocks and bonds.
Okay. No, I appreciate the background there. So you're based in Michigan today, correct? And it
Yes.
sounds like you own real estate. Is it mostly in the Southeast?
Yeah, that's where I started out, and I would say about
Okay.
as far north as Kansas City. So that's really just what made sense at the time, and over time, definitely moving further north. I would love to invest more in the Midwest going
Hmm.
forward.
Yeah. So let's talk about the first deal. I always like the foundation. Maybe not the first one, which was your primary residence, which then got converted into a rental, but maybe the first multifamily property. I think you referenced Orlando
Yeah.
was kind of the starting point. So maybe tell us a little bit more about that deal, how you found it, what excited you about it, and were there any deals that came before that one where you got cold feet and kind of turned the other direction?
Oh, I would say that was the first one we really got serious about. We must have
Okay.
underwritten well over 100 deals. Local group and I, we just all got together on Zoom each week, and we did our underwriting, our demographic research, and wow, after quite a search, this was the only thing that really made sense.
Hmm.
We went in, negotiated really hard for this thing, because look, if you want to get a great deal, you can't be afraid to lose it, right? You can't be afraid to walk away. And we just put in our lowball offer where we thought that we could get a great return on our investment. And lo and behold, it was accepted.
Hmm. And what year was this?
So this was 2020, and the reason why we got away with that lowball offer is that it was the middle of the year, and people were still very frightened because of the
Yeah.
pandemic. People were losing their jobs. It wasn't clear whether tenants were going to pay rent, and there were a couple of offers that just got yanked out from underneath the seller, and that seller was willing to accept a bit of a lower offer. But again, the fear was real at that time. We didn't know we were going to have to subsidize it or what.
Do you still own that property today?
We are, and we did. Let's see, it was. it was about 14 months ago, December 2023, that we refinanced it. So we went through the whole series of renovation, turning the tenant base, refinance, and then who knows, 2026 may be time for our second refinance.
Okay, so you guys were actually able to get refinanced in 2023. So even with the higher interest rates, you still had built
With
enough
higher
additional
interest rates,
equity.
and we locked just before the peak, and then by the time we closed, we were on the other side of the peak almost exactly
Yeah,
where we would have been if we had been able to float it. But yeah, we were very close to the top. But again, you got construction loans and things like that. What's a high interest rate depends on what you're referencing.
yeah. No, 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 fair enough. Valid point. Well, maybe let's take it in this direction. I mean, I guess, that was the first day you bought it mid 2020. Obviously, you bought a number of others during, what was seemingly the lowest interest rates in history. Now we're in a very different part of the cycle. And so just curious as to any pivotal moves that your team has made to really just overcome any of the volatility that we've experienced in the last couple of years, more specifically as it relates to rates.
Well, what I've learned is to focus on tertiary markets, mom and pop deals, places where you can get something that is truly underappreciated, under optimized. And, I say I'm buying at a discount, but if you run your deal into the ground, you will sell it at a discount.
Sure, sure.
So, I don't personally buy, say, a class A because look, there's really nowhere to go but down. You've got to run it at least as well as the last person who obviously kept it in great repair to keep it a class A. So I do like the value add, but there's another element to it. I have to have below market rents because if I can't raise the rents on day one, even before I raise a hammer, then where is my margin of safety? And what I like to do is, again, those smaller deals, those are the ones where you can find something that is truly under optimized, something where the landlord didn't keep up with the market. I can tell you from personal experience, I did it myself. My first, uh, my first rental as a single family landlord, I was a bioscientist. I was in a lab all day long, sometimes 12 hours, had a 3 hour round trip commute. Do you think I have time to get out there and deal with issues or to rent it back up if it's vacant? So we kept the rent steady for about 7 years. I mean, that's a crazy business decision, but I will tell you, people that are overly busy, they do that.
Hmm. Okay. No, no, all good. So what are you finding today? Are you able to still find, have you had some transactional activity over the past 18 months, acquiring new deals,
So I
finding
have to say
opportunities
that
that have had,
over that last 18 months, I don't think I have done a single deal. I mean, my last deal
yeah.
is getting a little bit aged at this point, but again, I think it's all about being in position, right? If you haven't lost any money during this latest real estate recession, you are in position to really, I would say, the pole position as things get better. And when is the best time to buy? I don't know. Maybe it's right now. Maybe it's, a few months from now. It might have been 6 months ago, but we are getting back to the point, and I'm seeing deals come in. I've got people sending me deals. Hey, George, you want to partner on this? And, the prices are just not necessarily all working out. I mean, another side to that is that I'm not necessarily trying all day to run more active deals. I got my book here. I'm becoming more of a passive investor. I'm enjoying that phase of my life as well.
Okay. No, all good. So let's talk about your background of being a data scientist and how you have been able to bring that expertise and that knowledge base into the investment world, real estate investment world.
The first thing is asking the right questions. People think of a data scientist as someone who applies the techniques of big data to solve problems. But I always say that the most important problem is the question of which problem you're trying to solve. So I'm looking largely for safety in the markets. And, everybody say, well, capital preservation is number one with us. If I had a dollar for every time I heard that. But the question is how do you go about that? And for me, it's going into some of these safer, more stable markets, not looking for the killing, but sometimes finding it, because these markets in the middle latitudes of our country, I think that's really where things make sense. Tennessee, Kentucky, at least outside of Nashville, Tennessee. These are places where you can get some very good deals. People are not rent constrained. You've got a lot of room to raise that rent as people move for affordability. Again, it's for me, it's all about capital preservation. You go to places that are more stable, that have seen uh, real estate values slowly rise over the last, say, 50 years. Areas like Tampa, Florida, uh, are places that I want to stay away from. So, again, I think it's all about answering the right questions. So, first of all, what's the most important thing? It is capital preservation. But number two, then how do we preserve that? How do we build in that margin of safety to our deals?
Yeah, no, no, great feedback there. Yeah, no, we're very much in interesting times. You mentioned you guys haven't done a deal in 18 months. I mean, I think there's some opportunity coming to the marketplace. I think for those that do not have to transact right now, those that don't have to sell, they're not, they're the backs, not against the wall. They don't have a debt maturity coming due, or they haven't found themselves in special servicing or on the watch list or anything like that, to where they're pressured now to make moves. They're not selling, and so a lot of things that are coming to market, I think there's some opportunity coming down the pike, and in the areas that you referenced, I think there's a great runway to still buy, especially speaking to the mom and pops, right? The mom and pop
Yeah,
run communities.
absolutely.
What's
I
the
think it's like,
size? What's kind of the target size? I mean, once you start getting 200 doors and above, you really start, especially in the markets that you just referenced there. There's still some bigger players that are in there trying to gobble up the bigger community. So are you guys finding yourselves playing in the kind of the mid-tier market, like the 50 to 150 size, or what's your
absolutely, that's exactly where I found my deals. And,
okay.
I felt like I was ready to move up into the big league, so to speak, just as those interest rates hit really hard. And I decided, you know what? Now's the time to focus on capital preservation. I've got this game going. Just continue to do what I've been doing, and make sure that I come out on the other side solid. Because I've seen so many people flame out, and it's because I have a lot of active partners, and because I'm a passive investor, a lot of passive partners. And I've seen this happen. And again, I think the first rule is just don't get knocked out of the game.
Yeah, yeah. So speaking from a passive partner's perspective, I mean, talk me through your due diligence process. I'd reference in the introduction there that you've got investments not just in multifamily, but in car washes, some early stage companies, triple net investments, which are have similarities but all very different, right, in their own right. And so, just really doing due diligence on the deals, but also the sponsors that are operating them. What is your process?
Yeah, so a few things. I think people try to skimp. They say, like, I'm just a passive investor. Never say that. You are an investor, you're a partner. And that's how I treat my partners in my active deals, as a partner. So I do all the sorts of things that I would do if I was going to partner with somebody actively. Go do a background check on them, even go fly out and see the property. When I invest in something passively, I'm probably in that market with some active investment. So even if I'm not, say the boots on the ground or the main partner on one of my active deals, I've got something else there that I can see
Hmm.
while I'm out there. Besides, it's never hurts to have an excuse to go right off a trip. So,
Sure.
get out there and make sure you are doing all the things that you would do for an active deal. One of my favorite investors, Peter Lynch, one up on
Hmm.
Wall Street, he ran the Magellan Fund. And he would say people will spend more money or more time, I should say, on an appliance purchase. It's the stock purchase. I mean, imagine that, a few $100s. And they'll be reading consumer reports and asking 1,000 questions, but they buy a stock and they look at the price, earnings, and the dividend. Don't do that. So make sure that you really are, again, putting the time in, because you are a partner in the deal, and whether that deal goes well or ill is going to impact your mental health over the next 3, 5, or even who knows 7 years. So definitely avoiding a bad deal will help you a lot more than finding a good deal.
Yeah, no, I agree with that. I mean, I guess more specifically, maybe like a part two of that same question would be like just car washes. Again, car washes, triple net investments, multifamily, they're all real estate, but they're all very different types of real estate. Car wash is much more of an operational business. Triple net lease is quite the opposite, right? Very credit driven per the tenant. Multifamily, again, similarities, but also very different. But just trying to gain an expertise, do you have kind of a quick method that allows you to dive in, like car washes, for example? I don't know where you're at as far as where you're at, like how many new car washes are popping up, but down here in Florida, they're everywhere. Really trying to get a sense of when is the market, going to find, absorption? When's it going to be, oversaturated? Trying to understand the risk factors involved with like those unique niches, like the car wash. I mean, that's really,
Great one. I
and
would love to take that.
during recessions. I mean, this is like, and I have some investments in car washes. So actually, and I've gone down this road, and it's a unique business. Because also the one thing that none of us know, and maybe you've got some data to support this, is one thing that we don't know yet is when we really do enter into a deeper recessionary period, how important will it be for folks to maintain that monthly membership and get their car wash, right? Like, when their
These are all great
discretionary
questions.
earnings
You
go
can remind
down,
me of all.
what
I can hit them
happens?
all. Yeah. So the first thing is they're popping up all over. So then my strategy was to invest in the Northeast, where in ways it's pretty built up, and you don't have just tons of property where people can
Yeah.
set up a new car wash. As for whether people will maintain those memberships during the tough times, I think a lot of people will. Consider that in the rougher areas, you don't have, in most cases, a garage to park. So you park that car outside, and that is a much larger representation of who you are to the world than in the cities. So depending on where you're located, if you're in an area that could be, say, closer to a rougher
Mhm.
area, in many ways, those people, I hate to say it, but the poor don't spend their money right. And they are more likely. I mean, look, I am quite wealthy, Kevin, but if you saw my car, and we're driving around here in Michigan, and we've got salt and everything, and that thing looks like a ghost. It's actually magenta, but it looks like a ghost. But because all that salt, and I don't get it. I don't get it washed because I got my focus on. I got to go on this podcast. I got to promote my book this week. I'm doing different things. So again, will they keep them? Yes, I think they do. I mean, I think there is a decent amount of recession proofness to it. But the other way is how do you approach it? Now, I invested through private equity, and the way they like to do everything, and we do this in multifamily. I say we, not me, but getting variable rate loans, which private equity does really well with the roll up play when rates are low. But when rates increase, things get very troubled. So, you got to look at how you're buying and who you're buying with and what their strategy is. So that's a lot to think about. But again, when private equity gets involved with things, they tend to do things differently. But when I say private equity, I'm talking about large private equity groups. As a
Mhm.
syndicator, I'm in private equity. You're in private equity. But anyway, sorry, a wordy answer. But the idea is, carefully look at that strategy and how things are financed. It's a big thing. I think a lot of people weren't doing that. They get a deal that looks good. Maybe the demographics are great. The projections look great. Our rent projections and our comps look beautiful, and then they invest in the deal. But if you didn't get that rate cap, boom.
Yeah. Yeah, no, I agree. So, in the triple net investments, like I think when a lot of folks think of triple net investments, where their mind really goes, and this is far from the truth. There's some truth to it, but Walgreens, CVS, I don't know why those are the two that primarily pop up, but surely there's a lot of other single tenant triple net. There's also a multi-tenant triple net, entire shopping centers that are all
Absolutely.
triple
Quick
net.
serve, all that.
Walgreens and CVS, again, I think that quickly comes to mind for a lot of folks. They're obviously closing a lot of stores, and so I'm not sure what the longevity of that business model looks like from a triple net standpoint. But just curious as to your involvement or interest in the triple net space. I mean, what type of investments are they? Single tenant, multi tenant? Just curious as to what kind of the profile of the investment looks like on that side of the house for you.
Right. Yeah. Well, my curiosity is wide ranging. I would consider all of those triple net investments, including industrial, for example. But
Industrial, yeah, yeah.
yeah, but yeah, what I ended up investing in was a drug rehab. I always wanted to be in something where you get to charge per bed. That is a really beautiful business model. Various ways you can do it: group homes. Uh, what am I trying to say? Senior living is like that, and student housing as well. But what I would say the big thing is addiction treatment. I mean, you pretty much have a captive population. They need it. You get some profit sharing in there as well, which is important to me because triple net, people look at that like a bond. You talk to a triple net broker, they're going to say, basically, you're buying a bond. You don't have to do anything. It's passive. Sort of. I mean, you're still in charge. Things can be run into the ground. You might have to find a new tenant if you don't have uh, a corporate guarantee. Watch out.
Sure.
And then again, that corporate guarantee could mean nothing if that company then, goes belly up, which there are some issues these days. At all times, there's an issue with the potential of that company going belly up. So, I was looking for something where there's that opportunity to essentially go beyond that sort of bond-like return.
Yeah, so yeah, I've actually never heard of I know what rehab facilities are, but like in the triple net sense, is that like a government entity that's actually leasing that property from you and operating it, or is it a private entity? Just curious.
Yeah, usually it's going to be
I've
that
never seen that
private
model
entity.
run in
Yeah,
that
so you got a
manner.
private entity owning the real estate, and then
Yep.
usually a tenant who knows how to run those businesses because they are very, very difficult to run. There's a lot of regulation. You have a pretty huge moat, but then you've also got extraordinary hurdles to cross just to open. And then once you open, it's very easy to be shut down if they don't like literally anything about your operations. For example, say you're running like a methadone clinic and you're not providing other services. Well, then the state can come in and you may have a license to run a methadone clinic, but if they don't like the supporting services, the therapy, and other supports for people in the community, then they're going to say, well, we don't like this.
Hmm.
You don't get a license just to dispense methadone. So you got to be very, very careful about it, and it's a double-edged sword. When you're working with the right people who are doing things ethically, who are very careful about accounting for every dollar, because I have property managers that I've dealt with, and they can't tell you how much they spent on this unit renovation, and that's unacceptable. But
Yeah.
whereas you can fire a property manager in the multifamily space and survive, this is one place where you literally cannot take any risks. So again, the idea I think is to find the right people, find somebody who's done it before, who knows how to open up these facilities. We have a tremendous need for it right now. We have opioid epidemic, everything from OxyContin and these I'm sorry, not over the counter, but these prescription opioids to fentanyl, and that's just destroying our country. It's like the crack of the 2020s because it's cheap and highly addictive, very easy to overdose on. So we
Hmm.
have at the one time we have serious demand. There's a definite need for this, and on the other hand, certain things like Obamacare and some changes in Medicare that were made during the first Trump administration that are causing a lot of things that were formerly not covered to be covered. So you really have both sides of it. You have got the demand, and on the second hand, you've got these payers that are willing to come in and make sure that this very expensive, very difficult to provide treatment is available.
Yeah. So the demand is there in that space, but really it comes down to just like it does with any other type of investment you're going to make, the sponsor, who's running the show, and do they, do they have a track record? I mean, do they have strong, company financials, and what's their credit worthiness? I mean, just again, just trying to evaluate the jockey, not the horse itself. No, all good there. Appreciate that insight. Let's go to the book. You've got a book. I mean, you got a lot going on, bud. You got a book, you got a podcast, you've got a YouTube channel that's active. Tell us about, those three things, what folks can learn by diving into each one. And I think you had referenced you're working on your book. You just launched the book, correct?
I did. I just launched it. So I
Okay.
want to say it was October of 2024. So it's about 4 months out.
Okay.
Already had book events, got my book signing coming up this weekend locally. So, I mean, for those of you that are interested in writing a book, before I even talk about the contents, you have to understand that launching the book is as much of a job as writing the book. So
Sure.
if you think, well, I've got the wherewithal to write a book and I'll get it out there, that's fine. But that may end up being a loss leader. If you really want to have a book like the ones you have behind you on that shelf, the ones that make an impact, you've really got to push. You got to get yourself out on these podcasts, and you've also got to go to the local events. I've got to go out to the real estate meetups. I got a trunk full of books. I sell my book. I'm pushing it all the time, pushing it out on Instagram and everything else. So yeah, uh, if you want to write a book, read a book about writing a book and then read a book about launching the book. Because as soon as you get it out there, you've got to have that plan. You got to have people to review it. If you get those reviews right away, then your book launches nicely. If you don't, then the algorithm is going to deprioritize you and you're going to find that people don't find your book. So, anyway, a lot about the process right there. But what it is, it's passionate living through passive investing. And it's really all about my life. It's about my life going from a scientist to an entrepreneur, now to somebody who has enough capital that I can largely live on this passive income.
Hmm.
And I go through all of the strategies for passive income, not just about, hey, I'm a multifamily syndicator. You should invest with me. It's all about there are 1,000 things you can do. You can invest in early stage companies, private equity. You can invest in apartments, triple net, all of these things, and they're all wonderful. Private lending is another thing that I love to talk about because it's a great buffer. We are going to have real estate recessions from time to time. Multifamily had a huge recession. We lost about a third from the peak in terms of the multifamily price index
Hmm.
at the trough. And things have been a little bit difficult right there. So if you're all on the equity side, you might be hurting right now. But if you have some of those private loans, remember you can always foreclose. So anyway, uh, again, just sort of a lightning tour there. I want people to know that there's a wide world of investing in these alternative assets, and really teach people how to get there. And remember, it's not all about just saving up a great big pile of poker chips and then cashing it in and saying, I'm retired. If you're not benefiting from that every day, there are plenty of cheap hobbies and things you can pursue. Like we were talking about sailing just before we started rolling the cameras. I bought myself a $5,000 sailboat. Okay. It doesn't have to be expensive. I put the sails up and I could make it around the world on a single tank of gas. So to me, there's no excuse to not live life's adventure, regardless of how much cash you have in the bank.
Yeah, I love it. I love it. And so, George, for those that want to grab a copy, where's the best place to track it down? Amazon, I'm assuming. Are there any
You can
other
track
areas
it
they can?
down on Amazon, and
Okay.
right now it's $2.99 on Kindle. And I think I'm going to keep that price low because I want to reach as many people as possible. But if you want the print, $9.99, totally affordable. And what I like to say is, like, if you don't find thousands of dollars of value in this book, then feel free to write me hate mail for that $2.99.
All good, all good. Well, George, this has been an absolute pleasure, guys. We'll get that, the link to the book as well as the podcast and YouTube channel. We'll get that in the show notes. And George, my friend, that's all we have today. I appreciate you coming on. Appreciate you sharing your story and just bringing incredible value to our audience here.
Thank you so much, Kevin. It's been a pleasure.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.